Happy Groundhog Day Monday, everybody. Today is February 2nd, 2026, and this is your Monday market update. Now, January ended with markets still near record levels, but with a noticeably more thoughtful tone. Early optimism around earnings and artificial intelligence gave way to more selective buying, rising volatility, and renewed debate about interest rates, currencies, and where leadership's going next. It was a week that reminded investors of an important planning lesson. Strong markets don't eliminate uncertainty, they often hide it. Now, let's recap last week and then let's look at the week ahead. Monday markets rebounded from overnight weakness as investors digested a mix of policy headlines and renewed enthusiasm about AI. Despite continued volatility overseas, particularly sharp moves in the Japanese yen and Japanese government bonds, U.S. stocks largely shrugged that off. Concerns about the potential government shutdown also faded after more constructive signals from Washington. Technology once again led the way after NVIDIA announced a multi-billion-dollar investment tied to AI infrastructure, reigniting enthusiasm around long-term spending trends. This also revisited that circular financing that we're seeing so much of in this area. Markets showed some resilience, but leadership remained narrow. Dow up just over half of 1%, the S&P up a half of 1%, and the Nasdaq up a little less than half of 1%. On Tuesday, S&P 500 pushed to another record close, but the internal picture became more mixed. Healthcare stocks led by United Healthcare weighed on the Dow, while growth stocks benefited from slightly lower bond yields. At the same time, consumer confidence slipped towards multi-year lows, reintroducing recession chatter even as indexes moved higher. It was another example of markets climbing while sending mixed signals underneath. The Dow was down just under 1%, nearly all from United Healthcare, and S&P 500 up about a half of 1%, and the Nasdaq was up just under 1%. Wednesday's market briefly crossed the psychological milestone as the S&P 500 traded above 7,000 for the first time before losing momentum. The Federal Reserve concluded its January meeting, holding rates steady as expected. Chair Powell did emphasize that growth remains solid and the labor market resilient, while inflation remains somewhat elevated. In other words, no rush. That message matters, especially as markets begin to price the timing of future cuts more cautiously. The Dow was up a fraction, S&P 500 was essentially flat, and the Nasdaq was up just under a quarter of 1%. By Thursday, volatility picked up again. Mega cap earnings highlighted a growing tension in the market, strong revenue growth on one hand, and rising capital expenditures, especially related to AI on the other hand. Currency markets also came into focus. A weaker US dollar earlier in the week pushed commodities sharply higher before profit taking set in. These cross currents added to intraday swings, even as dip buyers continue to show up. The Dow was up a tenth of 1%, S&P 500 down about a tenth of 1%, and the Nasdaq was down roughly 3/4 of 1%. Friday wrapped up the week with another reminder that markets don't move in straight lines. Precious metals, which had surged earlier in the week, as I said, sold off sharply as positioning became crowded. Silver, in particular, saw an unusually large move, underscoring how quickly sentiment can flip. Meanwhile, reports around the nomination of Kevin Warsh as the next Fed chair added another layer of uncertainty, even as progress towards avoiding a government shutdown helped limit broader damage. The Dow was down about a third of 1%, S&P down just under half of 1%, and the Nasdaq was down nearly 1%. For the week, the S&P 500 finished up almost a quarter of 1%. The Dow was down roughly 2/3 of 1%. The Nasdaq was down just under half of 1%. January still closed out positive overall for the S&P, but leadership narrowed, volatility increased, and investors became more selective. All of the January effect questions, every stat I've come across was about the S&P 500 being positive in January. Not seeing the additional investigations about the data on how positive and if the rest of the indices were not positive. So as always, as goes January, goes the year. That narrative is notable, but not as a planning tool. Let's look at the week ahead. This week's focus shifts squarely on jobs. January jobs report on Friday, which will help shape expectations around the Fed's next move. We'll get a bunch of eco data also and other jobs data throughout the week. Economists expect modest job growth, steady unemployment around 4.4%, and wage growth that remains firm but not accelerating. The key takeaway for markets isn't one number. It's whether the labor market is cooling gradually or abruptly. We'll also hear from several Fed officials throughout the week, reinforcing a theme that's been consistent lately: patience. We'll get Bostic today, Barkin and Bowman tomorrow, and then Cook Wednesday, and then Bostic steps back to the mic on Thursday. As we discussed in Friday's planning video, this is a moment where process matters more than reaction. Markets are evaluating data point by data point, not racing towards conclusions. We've also got some big earnings. We're in the meat of earnings season now. This week, we'll hear from some some companies that may move markets: Alphabet, Amazon, AMD, Pepsi, Lillian, Novo Nordisk, and even some of the oil companies. We'll watch to see if the earnings narrative changes. As of now, growth is still the story. January once again reminded investors of something that is easy to forget during strong markets. Progress doesn't require urgency, and clarity doesn't demand action. Good planning and good investing means staying focused on structure, discipline, and long term goals, especially when headlines start competing for attention. That mindset will matter as we move deeper into February. Have a great day and keep planning.